Hi guys, my name is Tom. Welcome to this week's video on how is an option contract priced, premium explained. Over the course of weeks and months, we're going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link and subscribe to our page. You'll also receive alerts when they are posted. Please also follow us on social media, Instagram, Twitter, and Facebook. So let's jump into this week's topic, which is how is an option contract price premium explained? Before we get into that, quick refresher on what an option is. So options are contracts that give the bearer the right, but not the obligation to either buy or sell an amount of an underlying asset at a predetermined price at or before a contract's expiration date. Option contracts are financial agreements between two parties to facilitate a potential transaction on an underlying security at a set price called strike price prior to an expiration date. When you buy an option contract, you can choose to either exercise your option contract on or before expiration date, or simply allow the option to expire unexercised. Options are an example of a derivative. So a derivative's price is depending or derived from the price of something else. Simple example is wine is a derivative of grapes. Fruit juice is a derivative of the underlying fruit. And then finally, options are a derivative of stocks. One option contract is called a contract, and each contract represents 100 shares of the stock. So, premium. What is a premium? What does it actually mean? So, when you pull up an option chain, there will be an associated price for each option contract. This price is the current market value of the option contract, which is called a premium. This premium is quoted as a dollar amount per share, with most contracts representing a commitment of 100 shares. In the money option premiums are composed of two things, intrinsic and extrinsic value, while out of the money option premiums consist solely of extrinsic value. Don't worry, we're going to explain what the terms intrinsic and extrinsic value means. First up, let's go with intrinsic. I like being in the money. So intrinsic value is an option's intrinsic value is the difference between the market price and the strike price of the underlying security. This value tells you that if the option were to be executed right now, it would return money. It has value. Hence, this is why only in the money option premiums contain intrinsic value. Therefore, they only have money. Now, extrinsic value. So intrinsic value, extrinsic value. So an option's extrinsic value is composed of two things, time value and implied volatility. So what's time value and implied volatility? Don't worry, we'll explain it. So time value of an option is the difference between the total cost of an option and its extrinsic value. The value represents an amount people are willing to pay over and above the intrinsic value. It is a length of time from the date of purchase to the expiration date. So the more time an option has until expiration, the greater the extrinsic value. As an option approaches expiration date, the extrinsic value decreases. And we look at a term called time decay. Implied volatility is the assumption of the stock's volatility that helps the option price. High implied volatility means the stock is expected to have large price swings, either up or down. So low implied volatility means the stock will have minimal to no swings in either directions. High implied volatility indicates a higher extrinsic value for the option, and conversely, low implied volatility indicates lower extrinsic value. So if low implied volatility means, this price is pretty set and solid, it's not going to move a lot. Therefore, if you buy something further away, it just won't have that value built into it, which means it'll actually be cheaper for you to purchase it. So one of the best ways to actually look at the price of an option contract in regards to the premium, understanding intrinsic and extrinsic value, is actually jump into a live brokerage account and let's look at how it actually how it looks like, because you can actually see the numbers build up to the final cost and it looks really great. So let's go ahead and jump into a live brokerage account now and have a look. So we've jumped into our brokerage platform and we're looking at an option chain here. The company we're looking at is BP, and we're going to look at how an option contract is priced, focusing on intrinsic and extrinsic value. So as I mentioned, so here is the expiration date, here's the strike price, here are the premiums. This is the market value for calls and puts. So as I mentioned, the price is quoted, this premium price is quoted as a, current market price is quoted as $1 per share. And each contract represents a commitment of 100 shares. In the money options, which are here, in the money call, in the money put, are composed of two things, intrinsic and extrinsic. Out of the money are just composed of extrinsic. Let's look at it. So here we are. In the money, it has intrinsic value. It has a number associated with it. Also has a number of extrinsic value associated. As soon as we get out of the money, above $21 for calls, below $21 for the puts, we go into this white area, meaning out of the money. Also, the intrinsic value goes straight to zero. What's zero? Because there's the intrinsic value means the difference between the market price and the strike price. Once you get above the market price and strike price, it gets to zero. You don't get negative. So that's why it gets less and less. And let's look at an example. So the current market price is $21, $21.38. This one's 20. So what's the intrinsic value? 0.38. Exactly that difference. Now go out. 19. That's why it increases. 19.19 plus 2.39. What do we get? 21.38. It should be 21.39, but it's obviously rounding a little bit there. That's why 19.5 plus 1.89 gets that. And that's why as you approach the strike points, the break-even strike points, it gets less and less and less. So what does that do to the price? Well, it decreases the price. The higher this extrinsic value, the higher the corresponding premium is. See here, 2.39, it's higher, 1.8, less, 1.39, less. And then eventually when you get rid of intrinsic value altogether, the only thing making up this premium is the extrinsic value. So now we know with intrinsic value, let's look at the extrinsic value. So depending on if it's in the money or out of the money, it has extrinsic value. Extrinsic value is broken into two things, time value and implied volatility. Time value is probably the easiest one to understand because we can visually see it really easily. So here we have time value. Here, let's look at this one, 21. Extrinsic value is 0.58. 21 days until expiration. Because time value is the total cost of the options and is the difference between the total cost of the option and its extrinsic value, this value represents an amount people are willing to pay over above the extrinsic value. It is a length of time from the date of purchase to the expiration date. So the more time, this should be higher, and we can test that. 21 days, let's go all the way out to 501. Close this. What did we say? 0.58. What does the extrinsic value jump up to? 2.21. So why did it do that? Because it has more time value. It has more, there's more time for things to happen. And the big thing is outside here, out of the money ones, because, the price of this option, the price of this contract right here, $21. There's a higher probability that in 1 month, it's going to be closer to $21 than any other way. It has to have a big price movement for not to be there. However, this option contract right here has an expiration date of 511 days, meaning it has so much time for the underlying stock price to move up and move down as good. So therefore, you have to pay a premium for that. And that's why this one here, 20, all it's 20 is $3.55. Well, the last one is $3.60. And let's do 20 here, $1.63. So literally, if you want to buy a stock which has an expiration date of nearly a whole year away, you will be paying nearly double. You have to double your investment. And that's because it has greater time value added to it. However, that's not the only thing adding into extrinsic value. So the implied volatility. So the more volatile stock, the more higher the price swings up and down. The lower the volatility, the lower the price swings up and down. You cannot visually see this from here, but if you go in and dig deep in and you turn some of these on, and you're looking at the volatility of the stock, the implied volatility, say implied volatility change, save, changes around. Let's get rid of theoretical price. So you can say here, the higher the implied volatility, the higher the extrinsic value, the more the price is. So that is how a premium price is quoted. So, break it down. Very simple. The further out, the more expensive the premium will be. Number one. The more in the money for calls and in the money for puts, the more expensive it will be because it has intrinsic value. If you want to buy cheap options, you look for close options. They expire tomorrow or and are also out of the money. But why would you do this? Well, you can do this, but it's taking a long shot. It's like betting on the worst team, the absolute worst team to win the Super Bowl. It theoretically can happen, but the chances of that happening is so minute, you might as well just get rid of your money. So that's why people don't do it. It's not recommended to buy deep out of the money, very close on, because something does happen. And, this year, being with coronavirus in 2020, it's not unheard of that it does happen. But generally, you wouldn't have a massive price swing like that. For example, like tomorrow, that's why they're all 0.1. They're 1 cent. So there we are. So that is how a premium is calculated, making up of extrinsic and intrinsic value. Intrinsic and extrinsic for in the money, and just solely extrinsic for out of the money. Thank you so much for watching our video this week on how option contracts are priced, premium. If you like this video, please click the subscribe button. Please also check out our website. Please also follow us on social media. We love to hear from you. Thanks so much for watching. Look forward to more content, and we'll see you later. Thank you.